If you've been thinking about setting up an SMSF for months or maybe even years, but you still haven't done anything about it, this video is for you. Not because I'm going to tell you that you should, but because most people who sit on the fence do so for one reason. They don't actually know what question they're trying to answer. Today, I want to give you a straight conversation about the 3 questions you need to honestly answer before you make any decision, and what the landscape looks like right now for someone starting fresh. Welcome to SMSF Insider, where we help busy professionals to gain financial independence using an SMSF. Hi, I'm Troy, founder of Blue Chip SMSF Services, and over the last 20 years, I've helped thousands of Aussies manage the complexities of self-managed super funds. And in this podcast, I'll answer your questions, break down the myths, so you can take charge of your financial freedom. Let's get into it. Let's start with the one mistake that stops most people before they even begin. They treat the decision like it's permanent. They think that setting up an SMSF is some kind of irreversible commitment that locks them in forever. It's not. An SMSF is a structure. If your circumstances change, you can wind it up. If it's not working for you, you have options. The paralysis most people feel isn't about the SMSF itself. It's about the fear of making the wrong call. And that fear is usually based on a misunderstanding of what the decision actually involves. So let's cut through that and get to the 3 questions that actually matter. The first question is, do you have enough in super to make it worthwhile? An SMSF has fixed running costs, annual accounting, tax return preparation, and an independent audit. Unlike industry funds, which charge a percentage of your balance, those costs don't change much as your balance grows. The general guidance is that somewhere around $200,000 to $250,000 in combined super is where an SMSF starts to become cost competitive. The second question is, do you actually want control over your investments? An SMSF gives you the ability to invest in direct property, specific shares, gold, private assets, and a range of things that simply aren't available inside a standard industry fund. But with that comes responsibility. You become the trustee of your own fund. You're responsible for ensuring the fund meets its compliance obligations. If the idea of having that control genuinely excites you, if you've been frustrated watching your industry fund make decisions you wouldn't make, then that's a meaningful signal. If the honest answer is that you'd rather not think about it, then a managed fund might genuinely suit you better. Neither answer is wrong, but you need to know which one is true for you. The third question is now actually a good time to act? This is where the current environment is worth paying attention to. And I want to be straight with you about what's changed, both the good and the not so good. The 2026 federal budget introduced some significant changes to the tax treatment of investments held outside of super. Capital gains tax concessions for individuals and trusts have been reduced. A minimum 30% tax on trust distributions is coming. Negative gearing restrictions have been tightened. None of those changes apply to superannuation. SMSFs were explicitly exempted. That means the gap between the tax treatment of assets held inside super versus outside super has just widened considerably. Payday super has also just come into effect, meaning contributions are now hitting funds faster and compounding sooner. Every dollar that lands in your fund earlier has more time to work for you. Now, on the other side, the government has just passed legislation banning SMSFs from borrowing to buy residential property. That option is no longer available for new arrangements. Just quickly, guys, if you're a busy professional, fed up with traditional super funds and overwhelmed by the setup of your SMSF, we can help. Book in a call with my team using the link in the show notes, and let's build your future on your terms. Now, back to the episode. But here's the context that matters. The ban only applies to borrowing for residential property. You can still buy residential property outright using cash inside your fund. And borrowing to buy commercial property, what's legally defined as business real property, is still fully available. So the landscape has shifted, but it hasn't closed. For most people who are genuinely considering an SMSF, the core reasons to act, tax efficiency, investment control, and the compounding advantage of getting your money working sooner, are still very much intact. If your balance is approaching that $200,000 to $250,000 range, if you want more control over where your money is invested, and if the current tax environment makes you want to take advantage of what's available inside super, those are the signals that it might be time to stop thinking and start having the right conversations. The mistake isn't setting up an SMSF when you shouldn't. The mistake is waiting so long that you miss years of compounding inside a structure that was working in your favour the whole time. If you want to get your SMSF set up or learn more about the process, you can book a free call with our team. The link is in the description. Thanks for tuning in to this episode of SMSF Insider. If you got value from this, make sure you subscribe so you never miss the strategies we share to help you take control of your financial future. Find us on socials at Blue Chip SMSF or book a call with our team to see if we can help you.